Hi guys, today we'll be discussing Alphabet, or Google, which currently trades at a price of $2,773 as of 10th of January. I think the price currently looks attractive enough to take a small entry position in the stock. Breaking down Alphabet's third quarter 2021 filings, Google generated $65 billion in revenue, of which 92% came from Google services, which are primarily advertising revenues. This segment is driven by Google search engine, which is the core business driver, but also includes YouTube. Another 8% came from Google Cloud Platform and Google Workspace. Google Cloud Platform, or GCP for short, is the IaaS and PaaS platform which provides cloud computing services such as storage, database, compute, and artificial intelligence and machine learning. Google Workspace is the SaaS suite of productivity apps including Gmail, Meet, Chat, Drive, and Docs. Other bets, which comprise of 0.3% of revenue, contains all non-Google businesses within Alphabet, and these are long-term, early-stage investments that are not profitable yet, including Wemo, Access, DeepMind, Google X, Google Ventures, and others. Just purely looking at historical financials, Google is extremely attractive. Its 4-year revenue CAGR was 22% and its EBITDA margins were over 30%. And I think few stocks are able to pull off what Google has done over the past few years. With long-term investing in mind, I've got 3 investment theses for Google. The first is that Google possesses a deep entrenched moat as the dominant player in search advertising, and it forms a duopoly with Facebook and digital advertising. The second investment thesis is that it has a long runway for YouTube, which has superior user engagement and high growth rates. And the last investment thesis is that even though Google Cloud Platform is slightly behind Azure and AWS, it will not be a lagging player due to its capabilities in data analytics and machine learning. With these theses, there are also 4 key risks to keep in mind. The first is privacy concerns or regulatory risks pertaining to antitrust. The second is the break-even timing for Google Cloud is slightly variable and could present short-term price volatility. The third is that their aggressive interest rate hikes this year could present more selling pressure on growth stocks. And the last would be any pullback in advertising growth. In terms of valuation, we'll cover that in the last part of the video, but all in all, Google's stock price has now currently trading around the 25 times forward earnings multiple, and this is in line with its 5-year average, which seems more or less reasonable to me. So now let's first take a look at Google's relatively mature business, which is advertising. First of all, Google has deep competitive moats within core search advertising, and this segment is exposed to long-term growth drivers such as secular growth in digital advertising and a shift from traditional to online media. In advertising, Google takes up more than 70% of market share in 2021, and the second largest player is Amazon, which is far behind at 16%. How search advertising works is that advertisers will use Google products and they can bid on search keywords, which are specific words and phrases that can lead up to the ads showing up to the relevant users in search results. And they can use different bidding strategies. One of the ways is cost per click bidding, which they will pay Google when someone clicks on their ads. We can be somewhat alarmed to see that Amazon is increasingly competing with Google in search. According to eMarketer analysts, which said the place where they are losing share is basically all about the search piece. And the reason they are losing share of search ads is because more of search ad spending is going to sites like Amazon, instead of general search sites like Google or Bing. However, I don't think that it's likely that Amazon can outshine Google in the long run. In digital advertising, Google and Facebook are the largest players with 29% and 24% of the market share in 2021 respectively. I think one thing to keep in mind is that the large suite of services that Google provides has yet to fully reflect the strength in advertising. For example, Google launched Maps in 2005, initially on desktop as a location-based software solution. More functionalities were then added over the years, including Google Earth, real-time traffic data, Street View, driving navigation, local businesses and guides, and Live View. Maps turned out to be a huge success, with over 1 billion monthly active users, which further widened the Google ecosystem. Now, these products are becoming more strategic on the ad side. Using Google Maps, advertisers can buy ads for local business listings and pins. This omni-channel approach to advertising targeting both online search and in-store objectives have allowed Google to effectively capitalize on the rebound in offline retail post-pandemic. Google doesn't actually break out how much its Maps business makes, but it's one of Google's most under-monetized products. According to Morgan Stanley analyst, he estimated that it could be worth $11 billion by the year 2023. Another of Alphabet's strength is its commitment to serious R&D. It spent a whopping 15% of its revenues on R&D in 2021, which indicates continual reinvestment to maintain its dominance in search. For example, it came out with something called the bidirectional encoder representation from Transformers, or BERT, which is such a long name, but this is a new type of natural language processing announced by Google in October 2019, and this was revolutionary in the industry. It was hailed as one of the most significant changes to Google search in the last 5 years. BERT has helped Google search better understand 1 in 10 searches in the US in English, and it was developed by Google after years of novel research within the natural language processing space. But that's not the end of it. Google came up with something called the New Multitask Unified Model, or MUM, which they claim is 1,000 times more powerful than BERT. And it can also understand information across text and images, in the future can expand to even video and audio, which is allowing search to become a more visual experience and is something that is critical for e-commerce advertising and should boost the search use case. So going forward, we can expect at least low teens in ad growth for US and worldwide, according to eMarketer. So let's take a look at YouTube right now. As a video platform, YouTube is the fastest growing segment within Google advertising and is the world's most popular online video platform. In fact, it is the second search platform in the world, only outranked by Google Search itself. Besides brand advertising, YouTube also introduced a new advertisement format called the direct response in the second quarter of 2020, and this is one of the largest and fastest growing features within YouTube. YouTube's new shoppable ad format allows brands to place product placements below a video ad, and it allows brands to use video advertisements as a storefront that connects to the advertiser's page. This makes video ads more shoppable and also leverages on purchase intent signals from Google's core search platform for targeting, which shows how well the synergies between Google's core search and YouTube is integrated. Credit Suisse estimated that such product updates to YouTube will help to personalize ads and boost YouTube's monetization in the long run, which currently the ARPU of YouTube stands at about $9 per user per year. And this is way under-monetized compared to Facebook, which monetizes it at about $30 per user per year. So now let's cover Google Cloud. Google Cloud is currently the third largest player in the global cloud market, and being a later entrant, it lags behind AWS by Amazon and Azure by Microsoft. According to industry research, these 3 players will become the hyperscalers, the dominant players in this area. And as storage and computing demands increase, these big 3 hyperscalers will continue to dominate given their already large existing footprint, increasing vertical expertise, scale, and resources. However, while AWS and Azure as well as GCP become more mature, we can see that these hyperscalers are moving away from just providing raw horsepower and instead shifting to becoming more strategic partners to these corporates, creating data-driven business models to disrupt an increasing number of industries. While cloud surveys show that Google Cloud is the third most strategic infrastructure and platform provider for companies after AWS and Azure, it is on near equal footing to the 2 others when it comes to AI and machine learning capabilities, which will become increasingly important in driving partnership decisions and the choice of cloud platform. Google is using its skills in algorithm development and machine learning, which it has developed over the years, to position itself as a data analytics partner for corporates. Now that we understand the 3 key investment theses, let's move on to one of the key risks, which is privacy issues. So Apple announced something called the IDFA, which is Identifier for Advertisers and requires Apple users to opt in to be tracked. Facebook was not happy about this, And its Chief Operating Officer, Sheryl Sandberg, said in an earnings call that firstly, the accuracy of its ad targeting will definitely be decreased, which has increased the cost of driving outcomes for advertisers. Facebook is working on developing tools and products that will allow it to show relevant ads to users while requiring minimal personal information, but Sandberg said that progress in these areas will take time. For Google's side, Google said that it will no longer use the IDFA and therefore will not show the prompt in those apps. However, Google is also working on some privacy issues. For example, it continues to make progress with its privacy sandbox technology and has introduced something called the Federated Learning of Cohorts, which is FLOC. This is something which groups users into various cohorts based on behavior and preferences rather than targeting individually. And this is powered by its machine learning and AI technology. This will replace third-party cookie tracking, and this will allow advertisers to target groups of people with common interests and replace individual identifiers. An early test run by Google also indicate that FLOC provides at least 95% of the conversion per dollar spent versus cookie-based advertising. I think what we can learn out of all of this is that there's definitely going to be higher traffic tracking difficulty if there are more of these privacy headwinds. With higher user tracking difficulty, more work needs to be done to achieve the same level of advertising return. This widens the leadership between more advanced players from the rest. Only companies like Google having the skill and capability to invest will be able to keep up with these changes and privacy updates. So now that we have understood more about the key investment thesis and risks, let's move on to valuation. So Google is currently trading at around its historical multiples. After all the correction in the market, it is trading slightly below its 5-year forward PE multiple of 26.63 times. Now it's trading around 25 times. However, this is still much higher than what the S&P has been trading at. In terms of relative valuation, for its growth profile, Alphabet actually trades cheaply compared to FAANG peers. And this makes it a relatively attractive value proposition in my mind. So I think at the current price of 2,700 plus, I think this would be a price that I could initiate a starter position in Google, but I'll be waiting for more market pullbacks to accumulate more of Google stock. And so with this, I've come to the end of my sharing on Google. If you've liked this video, please remember to subscribe and leave your comments down below, and see you in the next video.